The second example that we have for Chapter 18 looks at the comparison of absorption costing to a variable costing. So absorption costing is also called full costing. This is the normal costing method that we learned throughout the entire textbook. So this is our inventoriable cost that we use that follows US GAAP rules, require full costing, and it requires fixed manufacturing costs to be inventoried as part of our inventory costing. We use variable costing to look at manager performance compared to what the full costing is. If we produce and sell the exact same amount of inventory in a period, so we produce 1,000 units, we sell 1,000 units, our income will be exactly the same under full costing as it is under variable costing. What variable costing does is shows us how net income changes in comparison to changes in inventory carrying, so the amount of inventory that we have in stock. One of the reasons that we use variable costing to look at performance evaluation of managers is because managers can overproduce inventory and boost net income under full costing measures. So full costing, again, is what we normally do because of US GAAP. So what we do is we use variable costing, kind of double check and make sure that the manager isn't just overproducing inventory in an effort to boost net income. So we have all of this information here about our costs, our unit variable costs for manufacturing and selling, our fixed costs for selling and manufacturing, and the full manufacturing cost per unit. So we're going to create an income statement for full costing and variable costing for 2018. So our sales are exactly the same, which is the number of units sold, 24,000, times the sales price per unit. So that is the same under both costing methods. Then we're going to calculate our cost of goods sold. So we'll do full costing first. Our beginning inventory is 0. Our cost of goods produced is, under full costing, the number of units we produced times our full manufacturing cost per unit. So the amount that we have available for sale is the sum of beginning inventory plus the cost of goods produced. We then subtract the ending inventory value, and that gives us our cost of goods sold. So we have 1,000 units in ending inventory times the $24 full manufacturing cost per unit. Our cost of goods sold is the available for sale minus our ending inventory, giving us, then we're going to, so that gives us a gross margin of sales minus cost of goods sold. So this variable selling is for the variable costing method, which gives us a contribution margin instead of a gross margin. We then take out our selling and administrative costs. So our variable costs are the number of units sold times 50 cents per unit for variable selling and administration. And our fixed variable selling costs are 500. So our total giving us an operating income of gross margin minus selling and fixing costs. Now we'll look at the variable cost. So again, we have this beginning inventory of 0. Now our cost of goods produced takes the number produced times only the variable cost of manufacturing. So we produce 25,000 and our variable cost for manufacturing is $16 a unit. So our available for sale under variable costing is 400,000 versus our available for sale under the full costing because we've removed those fixed costs. The ending inventory, then we take the 1,000 units in ending inventory times that cost of $16, giving us a cost of goods sold of 384,000. We'll also add the variable selling costs here. So our 24,000 units times the 50 cents per variable cost. So the contribution margin is our sales minus our variable costs. We then have our fixed manufacturing costs and our fixed selling and administrative costs. So our fixed manufacturing costs, $200,000, and our fixed selling and administration costs are $500. Contribution margin minus fixed costs gives us our income. So now we can see that income is lower under the variable costing. This is because we produced 1,000 more than we sold. So if we overproduce inventory, we can create a greater operating income under the full costing method. So a way to evaluate manager performance and make sure that they're not overproducing inventory is to prepare a variable or contribution margin income statement to look at that. Our last example in Chapter 18 is looking at a balanced scorecard measure. So we have a lot of information about this lighting fixtures division and how we calculate our bonuses. So we have this 10%, we have lighting fixtures and electronic timing devices for this company. The company has really just not been really innovative, does have regular customers, but we have some information here now for the previous year. This is our budget for the year. And we find out that during the year we have a new CEO. So we normally give our managers bonuses based on any planned product line net income by 10%. So if they exceed what our budget was by 10%. The new CEO has decided to cancel the line of mid-range products and focus instead on electronic timing devices and the upscale lighting fixtures. The sales department has told him that this will be successful if they add advertising expenses. So he's done so. And we get the projections for the end of the fiscal year. So the close of the fiscal year, the division controllers are given information to review and adjust as appropriate. And what they found was that where they were in operating income or loss. So the mid-range was canceled partway through the year, and instead we focused on devices and upscale. we did sell more than we had originally budgeted. So if we compare our budget to our actual, we see that the upscale division more than exceeded that 10% amount. But the electronic timing devices has not exceeded that 10% bonus amount. The questions we have here then is that the controller of the lighting fixtures division is thinking about deferring revenue in order to guarantee that he also gets a benefit next year. So the revenues, of course, more than exceed to give him a 10% bonus, the 10% requirement to give him a bonus this year. And he thinks that deferring any of that extra revenue to next year would be beneficial to him. So we have a variety of questions about this company. So the first one is, did the CEO make the correct decision to kill the mid-range? And yes, he did, because we can see that the increased contribution margin from the lighting fixtures upscale and the electronic timing devices more than made up for those extra selling costs. Then the second question is, what are these benefits that an organization realizes from having segment reporting or different division reporting? Well, it allows them to look at divisions side by side and really evaluate what is happening in those divisions. It gives us a good idea of when a division should be cut or ended, which divisions we should reward for performance. Then we have, why would the management of the electronics timing division be unhappy with the current reporting? Well, this is because they are not going to get their bonus. So the allocated amount projected is means that they're not going to get their 10% bonus. And then, why are the adjustments contemplated by the controller of the lighting fixture division unethical? Well, deferring revenues just to affect your bonus structure violates the matching principle. It violates US GAAP, which is all unethical practices. So he would be committing fraud in an effort to boost his bonus for next year. And the last question here asks us to develop a balanced scorecard for this company and various items that we could put in that and measures. So of course we know that the balanced scorecard, it has customer perspective, financial perspective, operations perspective, and then the learning and growth perspective. There's a wide variety of things that we could put in these measurements. Of course, our financial perspective, we can have contribution margin growth, sales growth, any of the financial ratios, gross margin percentage, current ratio, ROI. From the customer perspective, of course, we know that we can have different things like customer satisfaction, repeat customers, number of new customers, customer loyalty, customer complaints, customer survey results. Then from our operations perspective, different things that we can look at are our lead time on orders, that customer lead time, our manufacturing cycle efficiency or cycle time, the our work in process time, the plant productivity, and variance analysis. And then in learning and growth, we look at employee training measures. So how much is spent on employee training? How many hours do employees train? What is our employee retention? Do we have employee satisfaction, etc.? So we know that there's really an unlimited number of possibilities that we can put into a balanced scorecard. They should be designed for each organization individually and should line up with that organization's strategic goals.